So, good afternoon, ladies and gentlemen. I'm glad that you could make it to this late session, graveyard session in the afternoon, and hope you're all wide awake and ready for a very interesting discussion on the credit risks that could topple the covered bond market. Could they? I don't know. This is what we're here to examine. I'd like my fellow panelists to introduce themselves, starting from my right here.
All right, thank you so much. My name is Sigmund Aas. I work at Eiendomsvurdet in Norway, and I'm here representing the European AVM Alliance. We do cover pool valuations, using statistical models on residential property, and we've actually just published the first European standards for statistical valuation models. So if anyone wants to get some more details into how to build a good model, you can talk to us afterwards.
Good afternoon. My name is Juan David Garcia from Fitch Ratings, based in Madrid, and I do the analysis on covered bonds and securitizations, mainly Spain, Portugal, and Greece.
My name is Bill Thornhill. I'm editor of The Cover, which is now part of Global Capital.
My name is Georg Grodzki. I'm CIO of Böhler Asset Management, which is a bond fund investing across a range of assets starting from AAA down to BB, and covered bonds are always interesting for a number of reasons. Not always a spread, but liquidity and shelter from spikes in volatility. So therefore, we do have more than an opportunistic interest in the asset class.
Hi, I'm Fritz Leutlin from DZ Bank. I'm head of covered bonds over there on the primary market side. And Sigmund, if I ever write a book, I'm going to bring it here too, and then we can sort of hold it in there. We even have a camera, so we can hold it.
Exactly.
In the camera. It's brilliant.
Hello, my name is Oliver Wagner. I'm investment manager in the treasury department of one of the largest German cooperative banks. So we are working in the same area. And yeah, I'm responsible for trading and analyzing fixed income, especially covered bonds.
So I don't know if you've had a chance to download your apps, but there is an opportunity to vote on today's panel. And the question that we wanted to ask you all is, which credit risk should investors be most worried about? And I'm hoping that the answers will come up there. Fantastic. So it seems like credit risk is you're most worried about house prices and the underlying assets.
But Bill, that's not what we had discussed. That's it's a surprise.
Okay.
I'm very happy to see this. I mean, this is what we do. So,
Sigmund, since this is what you do, what should we be worried about house prices? And I mean, in Scandinavia, we saw in Oslo, for example, house prices rose 20% last year. I think they're down 20% this year because of some of the measures that the FSA has put in place. How can investors mitigate against these risks using wonderful valuation techniques?
oh, thank you so much, Bill. First of all, it's not down by quite as much as 20% in Oslo, but the market has certainly taken a turn for the worse. I think, one of the obvious problems with the housing market is that they're all local, right? So, and it's difficult to find good data for lots of European or for some European countries. So it has to be looked at individually. But one thing that at least we at the European AVM Alliance do, we supply issuers with a possible process and possible systems to monitor the values of their collateral on an ongoing basis. So we provide quarterly individual valuations of every single property going into the pool. And we have tested our models through market crashes and market increases. So we can document to investors, to issuers, to regulatory authorities that if you use a good model, you will always know what the collateral is worth.
Is that something that could be applied in Spain, perhaps? Because we haven't seen, as far as I'm aware, there's only 2 or 3 issuers in Spain that currently update their pools on a regular basis?
This can definitely be done in Spain. There is a member of the EAA from Spain, TINSA.
Right.
So you will have, this can now be applied in most European countries.
So Juan, I mean, one of the things that came across when we went through the crisis in 2008 was, you know, the sharp drop that we saw in Spanish house prices, and you know, everybody kind of knew that the LTV levels were sort of way beyond the legal maximum, but there was no way of proving it because you know, everything was valued versus where the loans were originated at. You know, what's your experience been? You were saying earlier on before that, you know, quite a lot of people had lost their houses, and what's your experience been of the Spanish sort of situation, and how potentially, you know, valuations, up-to-date valuations could improve the matters, and sort of drawing into that as well, you've got the Cédulas framework, which doesn't really sort of fit in with the overall sort of harmonised debate that we're seeing at the moment, whether there's room there for that to sort of fit into the overall principles that the EBA is putting forward.
Yeah, so I try to keep it simple, but we learned a lesson, and at Fitch we have a shelf of research that we call the Spanish repossession analysis. And to focus on one key finding is that actual sale values on repossessed property suffered much more than obviously the national index. So when you do the loss study, obviously you need to extrapolate from the national index, but you need to include additional stresses because the properties that are there are obviously on defaulted loans, and most likely the properties will be deteriorated. That's one key lesson. The other lesson is obvious, you just said, probably the Cédulas framework needs an update. And everybody knew, as you just said it, that the LTV was not accurate, right? I can tell you that obviously, as we were learning with this repossession analysis, typically and most likely across the continent, the expectation on recoveries that we have in Spain, Portugal too, are pretty much the lowest of the continent. So in a base case scenario, we roughly approximate 50% recovery rate. Now, the last idea, when we talk about, and I appreciate also that this is the answer, underlying assets, so obviously we talk about the property market, and also what we learned a lot is loan restructuring and loan refinancings. And that was an element that I wanted to contribute for today's debate. We obviously are making significant progress in harmonized templates, but as far as we know from this part of the continent, there is not enough evidence and transparency in loan forbearance. There are various jurisdictions that have learned the lesson that obviously you need to go and claim the recovery, which is a property, but if you can restructure the loan, probably is better. So the whole restructuring reporting at the moment is very thin. And obviously we welcome, every time we do the analysis, the issuer and transaction parties to tell us how many restructurings they do, how many they've done, and what's the outcome.
So what would be your advice to the regulators and the people in the industry who could help steer things forward so that in the event, you know, another crisis happens, that the market's prepared for it?
Yeah. I mean, one thing is really beneficial is the EBA published, for example, for the continent NPL and NPE ratios, publicly available on their website. So you can already see, for example, in Greece, you have a stock of NPLs and forbearance loans, which is something like 40% of GDP. So that is something new. So the recommendation, again, is obviously the more transparency can be provided in loan forbearance, which is obviously a very proactive loan restructuring measure, which makes perfect sense in periods of crisis. Then obviously investors and market players in covered bond space, even though the NPLs typically are removed from covered pools, but the better knowledge and the better information is available.
George, turning to you, from your perspective, from the investor side, just thinking about sort of the jurisdictions. We've had sort of house price inflation everywhere across Europe, and you know, the risk of the ECB withdrawing and rate rises means potentially that there are the risks all over the place, especially in the UK with Brexit as well. Where do you see where do you see the most risks and the best protection? Is as you look across Europe, where are you sort of worried and less worried?
Let me step back a little before answering your question. My hunch is that the next housing bubble deflation, so to say, the next housing market crisis will be very different to the previous one, because in most European geographies we now have a real shortage of housing, and whereas in, say, 2006-07, Ireland and Spain as well got into trouble because of a massive overbuilding situation. The construction industry had expanded too fast, too much vacant, newly built property was weighing on the market, and when that construction boom stopped, a lot of employment disappeared, unemployment rocketed, and therefore, of course, many households were struggling to keep up payments. It will be different, at least if there is a crisis emerging, and we will come to that in a second, in the other countries, including the UK, where there is a shortage of housing, there is no building boom, which could create an imbalance between demand and supply. And it's in none of these countries the construction sector has suddenly grown to a proportion which is non-sustainable. But what could happen, and that now comes to your question, is that those people who have been unfortunate enough to have raised a mortgage recently and have bought at current or recent house prices will be affected, depending on the type of the interest rate, by a rate rise, and that will just raise an affordability issue. But it won't be the oversupply of freshly developed and newly built but unsold properties which is weighing on the market. So what will happen then? And my view is that in that scenario of many, especially recently made, so to say, recently created homeowners struggling to keep up payments because they borrowed as much as they could afford at low interest rates, and that is not enough. They don't have enough income to stomach high interest rates. There will be political intervention, because these people cannot be easily rehoused elsewhere. If you wanted to repossess them, they just have nowhere to go, and therefore it would be very tough for any mortgage lender, covered bond issuers included, to kick defaulting borrowers out. So there will be pressure on these lenders to accommodate stretch terms and other measures to accommodate the payment difficulties. So that's the dilemma for the central banks. The Bank of England, I don't know if you've seen it today, dropped hints they will raise rates in the next few months. Well, they've said that before, but the Bank of England is very concerned about that, but nobody knows what to do about it, because they are tightening the lending criteria for mortgages, but the longer this issue progresses, the harder it will be for central banks to actually execute a rate rise without causing a widespread affordability pain and possibly payment arrears for the banking system. So therefore, there is no template which I can think of, there is no historical precedence which I can think of which could describe that type of housing crisis, but it is an affordability crisis. It's not the overbuilding boom bust scenario which we had 10 years ago and possibly also 25 years ago. If you go back further in history, it will be something quite different. And we won't have probably an employment crisis either, because most European economies, or many European economies, actually show relatively high employment ratios, and the UK in particular has employment levels at record highs, and the same applies to Germany, and the Nordics are doing well. So we're talking about a full employment, shortage of residential accommodation environment, but payment arrears could happen because of the stretched mortgage to income levels. And as I said, there is no template, but my hunch is it will be very difficult for banks to enforce collateral and to basically avoid a rise in NPLs in the old-fashioned way.
On the affordability issue, we mustn't also forget that, of course, there's the internal ratings-based output floor now, coming to banks, and that is going to hurt quite a lot of capital positions out there. I mean, you know, what we're going to see is that probably portfolios, you know, we're going to start seeing more portfolio sales from banks to insurance companies, where Solvency II treats you know, that more lightly than in the banking case through the IRB floor, and it's not going to weigh on supply in the short term, but it's going to put pressure on the rates, because you need to have more capital for your mortgages as a bank, so you need to increase the price you charge, and that will come on top of what you've described. Yeah.
But in terms of the actual covered bond mitigants, when you look at the way a covered bond is structured, I mean, are there any things? I mean, is over collateralization and having a sort of a level of quality in the collateral pool and transparency, Fritz, is that something that can help mitigate against?
Well, the over-collateralization, the way we normally think of it, refers to the value of the market value, the perceived estimated market value of the underlying asset relative to the amount of debt at time of default, mortgage debt. The over-collateralization, which is more important in the current environment, is basically the disposable income the borrower has after meeting their cost of living and after meeting the mortgage payment. So that is, if you want, so the leverage, to use that term, which really matters. Do they have flex in their monthly cash flows to accommodate what Fritz just described, a rise in borrowing costs due to tighter capital requirements, or a rise in borrowing costs due to monetary policy measures, whatever they are, tapering or interest rate rises.
How easy is it to sort of get hold of that information on cover pools?
Not easy.
Right, okay.
I see this problem, what Georg mentioned, only with new loans, because if you look on the European covered bond markets, you see a tendency to make mortgages with fixed rates and less floating rates. So the clients are going to fix their rates for longer terms now. So if we see some rise in the interest rate, it's only for the new mortgages. So then you can evaluate it on a new perspective for the new clients. But on the outstanding mortgages, I don't see this risk at all. Yep. And you have to take in mind that the disposable income is one part of the mortgage, and in all the research reports, you don't see how much assets the mortgage lender has. It's backing up the own affordability for mortgages.
Can
Three people. Fritz.
Can I? All this is of course very complicated and intricate, and I think I disagree with 76% of you who are able to use that app. And I know, you know, the question comes quickly and then you start sort of scrolling. So the credit risk associated with house prices and underlying assets is, yes, I mean, that is it is a concern. What I'm personally more concerned with, and what I also better understand, to be quite honest, is the political risk. That is.
Well, that was coming second at 25%.
Yeah, all right, fair enough. You tell me when we move to that bit. Yeah,
we're moving to that bit now.
Well, see, it's down to only 22% now.
Political risk.
So my statement didn't help at all.
Apparently not. No, I think I just want to while I do wholeheartedly agree that I mean one of the main risks going forward is people simply. I mean, we all know if interest rates increase significantly, there are going to be an enormous amount of people who can't afford their mortgage, since people have now had time to sort of adjust to what may be or to the long period of low rates. But at the end of the day, I mean, you're not going to lose money on a mortgage if the house isn't sold for less than the mortgage. And since covered bonds 75-60%, the valuation is the key. If you have obviously I'm selling my own book now, but if you have a proper valuation, it's very difficult to see how you can actually lose money on a mortgage. If the valuation is right, it's very easy to see how you can lose money on a mortgage if your valuation is not right. And that will also increase the risk of the borrower taking on mortgages that they can't afford, right?
That assumes you repossess, you actually enforce the collateral, you liquidate it.
Yeah.
The question is, are you really able as a mortgage lender to do so? Well, a few occasions every year, yes. But if suddenly next year you have to do it 5 times as much as last year, will there be suddenly resistance building to sort of a widespread rise in repossessions due to the likely popular backlash?
No, I think you're entirely right. I mean, in a systemic crisis, obviously you can't just kick everybody out on the street. So again, that's why you need good systems in place before things hit the fan and everything goes in the wrong direction. Again, which is why I think now is the good time to make sure that all the banks and the mortgage lenders have proper systems in place so that you don't lend out against valuations that are too high, so that you don't lend out against, give people a mortgage that's too high that they can't afford if the world changes. So this is a collaboration between suppliers like us and between the regulatory authorities in each country.
Before we move on to the next political one.
Yeah, I just wanted to, I think you said it, and I kind of agree, but to the question whether this is a genuine risk driver when we conduct the analysis, my answer would be, it's too soon. I would say we need to be alert. And grabbing the ideas of the panelist members too, I want to summarize is that we pay attention to property market dynamics. You may have defaults, but the valuation is so comfortable, then never show any loss. But the fundamental is affordability, right? So on affordability, we connect always to the labor market. So labor market dynamics and wage dynamics. And through the cycle, I would say if we want to be alert, we always look at employment and quality of employment statistics.
Okay, so coming back to the political and supervisory intervention, so whilst we're here in lovely Barcelona, as you know, there's been a referendum here recently, Catalan independence, and maybe there's a level of political risk there. Maybe who knows what happens to the cover pools of Spanish covered bonds in a situation where this area becomes a republic.
Can I ask you something? Can you measure political risk?
No, I don't think so. You can opine.
So what we're actually talking about is much worse. That's uncertainty, and I think the Catalan example. I mean, that's the worst. That's one of the worst examples that we've seen recently, and amongst many bad examples, starting from Brexit and going through other countries in Europe where you have these populist governments. And I think it's worthwhile remembering what populism is. It's the worst kind of lie to a government towards its people, because it's the lie that they want to believe, and that's so dangerous. It boggles the mind, and that is, of course, the Catalan example that you've brought. If that were to happen, even though it is unconstitutional in Spain and so on and so forth, and there's a lot of shuffling whether they will have that referendum here or not. Then you are in absolute no man's land, and there is no way how to price that or how to qualify that, and we see that in many other jurisdictions now as well, unfortunately.
Does it matter?
Not
I
many,
mean, let me just ask: does it matter? We had secession risk and secession events at various points in time over the last 30 years. I do recall the Quebec situation when Quebec was on the verge of splitting off from Canada. We now have Estonian, Lithuanian covered bonds. These countries didn't even exist 30 years ago. So is that something investors can't handle? No, I could give a short answer, which is once there's a covered bond directive, any newly created country, as long as it joins or remains within the European Union, will of course have to comply. So therefore, does it really matter whether it's a regional government, it's a national government, because their competencies will be predetermined or they will be limited in certain aspects relevant to us by whatever the EU directive is saying. You will have a bit of disruption, perfectly correct, but I think it would be a bit far-fetched to assume that whatever breakaway country in the future is created in an orderly or disorderly fashion will immediately resort to measures which are extremely borrower-friendly, and thereby destroying its future credibility and with investors for a long time to come, because usually these small countries need foreign capital and would shoot themselves in the foot if the first thing they were to do were to hurt foreign investors.
Don't we have one experience with that as well? I mean, Czechoslovakia, I don't know whether they had a large covered bond market when they split up, but as I recall, they didn't create a credit crisis in either Czechia or Slovakia.
There's also political risk. Sorry, but go ahead. What were you going to say?
Sure.
Yeah.
Okay. No, I tend to agree that there's a big unknown and uncertainty, but through the crisis, inclusive of Spain, Portugal, and Greece, which are evidence, so we can look at what has happened there, it tends to be that economic interests at the end of the day influence policymakers. Because if you think about it, and if you sort of open the door for tactical defaults because that's your idea, and people vote for you.
Yeah.
And then you see the consequences because they are there to be seen. And I would say it's not on the headlines, but there's a big lesson being learned. And the tactical defaulters in Southern European countries are not improving by no means their quality of life, while the banking system needs to manage a huge bottleneck of NPLs. Yeah. So I would say the evidence probably speaks between the line, and I'm of the opinion that the economic well-being ultimately will have more power to influence policy making than the other way around.
Yeah, I actually think that because in the scenario that you paint, would be something along Venezuela, right? And then nothing really matters anymore.
Yeah.
So we basically have once the situation gets so bad that you need canned food and shotguns, the covered bond situation is probably one of your smaller problems.
I love Georg sort of giving the best argument for the European Union that I've heard in a long time.
That's true.
We should tell Luca about this, and he's going to love talking to the European Commission.
What about the political risk of unintended consequences of bad regulation or not thought through regulation? And here I'm thinking that is actually the ECB probably had intended to do this, but it has led to some questions in my mind. But they have decided to stop providing liquidity to wind down entities, which kind of goes against the Fan-Brief law a little bit, because the Fan-Brief law basically has written in it that wind down entities should be able to get access to Bundesbank liquidity. So I'm wondering there what's going on between the ECB and the Bundesbank, and what the ECB is thinking, because clearly, if a wind-down entity can't get hold of liquidity, then the risk of extension and potentially a covered bond default has got to be materially increased, in my opinion. That's just one example. Any thoughts about what's going on there in the Fan-Brief market with the ECB's decision on?
I think that's more liquidity risk than credit risk for once, and I think the Bundesbank and the ECB love each other. I think it's you can see that, and I'm sure they've. I think you have a good statement on that front. I personally, I think yes, maybe it's not the best of policies, but I think we will be able to sort of work around that quite easily.
Well, that brings me again back to the EU and the unexpected, unintended, well, intended but unexpected merits of EU directives. It would be smart if any EU directive on covered bonds would drop at least a word, or even better, a whole paragraph on the provisions being in place for the undesirable but not impossible scenario of a covered bond pool and the related covered bond liabilities being separated from an institution, and the provisions being in place for that newly created good bank, so to say, probably not a bank, but good entity, which then is entrusted or is tasked with ensuring smooth, continued servicing. Being thought through, that means all countries in the EU should have made sure that their bankruptcy laws and so on and so forth are compliant with that scenario, that the unsecured creditors could not challenge that separation and so on and so forth. But also, there should be provisions in place that these entities, these runoff entities of covered bond pools and related covered bond liabilities, are being provided with liabilities. So the EU might then just give a gentle reminder to the ECB, hey, you've got a job to do there. Hopefully it will never be necessary, but you have to stand ready, because you don't want to accidentally knock a dent into the confidence of investors into covered bonds being properly bankruptcy remote and bankruptcy proof.
Sort of while we're talking about supervision and politics, and since we're in Spain, I'm very much sort of drawn to the situation that's going on with regard to the cedulas market being slightly out of sync with the rest of the covered bond market in terms of the encumbrance that it has, and the fact that you had that Treasury paper, I think it was put out 2 years ago, where they were suggesting a whole load of good ideas, but the implementation is going to be the real big issue there, and that obviously carries with it all sorts of risks, political risks, if you like, if it's not, or regulatory risks if it's not done properly. What are your thoughts, Juan, about the process by which Spain potentially moves to a more harmonised framework? Do you think it will ever happen? Can they continue? Will they grandfather their existing deals? Where do you think it's going? Because it seems to have just stalled.
I mean, I will start by saying that obviously we were all anxious and maybe disappointed that they didn't crystallize the exercise. Now we obviously acknowledge that they need to wait, because there's the European directive process going on. They cannot sort of interfere now halfway through it and then update a paper which is not compatible with the European directive. Overall, probably you're right, but at the same time, this sort of waiting period seems to me that is sort of signaling that let's hope that the covered bond product remains obviously plain vanilla, simple, easy to understood by investors in other jurisdictions. And that's obviously something that speaks very, in my opinion, good about cedulas. Cedulas obviously have been static for like 20-something years or something like that. So I think the cedulas present themselves in 1.5 pages, which is fantastic, right? Because I think no investor needs to read 300 pages of a structured covered bond, shell company here, tax laws. No, it's in 1.5 pages. But it's true that whenever they are prepared to move forward with updates, then the question mark is the transition period. And I don't know exactly how they will manage, because with hundreds of billions of outstanding, I don't know how they will differentiate. It's an open question. I don't know about that one.
So, I mean, moving on to sort of another one of the points that we had there was structural and legal and contractual weaknesses. We've got the harmonisation process coming forward. The directives should be out sort of in the first quarter of next year. Do you think the contractual provisions of that are sort of laid down in covered bond sort of contracts, as it were, or even in law, can be relied on, or do you see potential for, you know, in cases where there's a systemic issue potentially, that the regulator steps in and swerves it and changes it? Do you think contract is good, or is something that can be relied on?
I don't think anyone worried about it.
Just
kidding. And we should not worry about what nobody worries about.
If you cannot, that's the fundamental principle. That's the fundamental principle of how our societies work. Is that, you know, what is if you're a smart person, you would say something like "Pacta sunt servanda." You know, it's a Roman principle. And that's you know, if we don't have a contract, and if we cannot rely on a contract, sorry, then that's it. I mean, the world is an exchange of rights all the time. So those have to be reliable. And I think maybe that's something that we need to think more about. Again, it touches back to the political side. You need to look at where the jurisdictions, what history these jurisdictions have in being reliable, providing a reliable legal background. I mean, in the UK, no matter whether you have Brexit or not, it's just not. It's unfathomable that somebody would not adhere to the contract written. In Germany, even though it's a different legal system, you'd have the same.
Fritz, you might not have been around at the time, but the UK government did override existing bond indenture contracts. I think it was Northern Rock and a few other institutions. I do remember it in 2008 and 2009, and there was.
I was around then.
You were. you look so dynamic. That's why. So therefore, there was wide uproar, you know, in the UK institutional investor community, led by the ABI at the time, that the sanctity of contracts was not respected, and it was really one of the darkest moments in the history of UK law and UK politics. And I think it was challenged, but it was a very lengthy process to challenge it. But the holders of subordinated bonds of a number of building societies basically were told that what was written, what was agreed, you know, is no longer applicable. And the ranking of creditors was basically changed around. In that case, similar to what happened in other countries, to please retail holders, because politically it was they were considered more inconvenient to be harmed than a few institutions which had bought.
So
the
basically,
higher
what you're
ranking.
saying is political expediency will always rule.
And that was the UK in 2008-9. It was not concerning big issues. I mean, large benchmark issues, but small issues. But in the meantime, we've had the legislation being rolled out about recovery and resolution, which provides regulators with such wide-ranging powers to basically, they can do what they want. I mean, as far as senior unsecured bonds are concerned, you know, I would not trust for a single minute what's written in the contracts. The regulators have even legally the right, and even if they didn't have the right, they would just take the right. If they feel that they only hit a few big fat pockets which have very little political clout, they will basically tell them, look, you know, that whatever you thought you will get, you won't get, and you won't have much of a legal challenge. You can try, but good luck. So therefore, I don't know whether this is a risk for covered bonds, because only time will tell. But given the direction of travel in regulation and interventionist supervision, we have seen over the past 5 years, nothing should be ruled out.
Okay, Oliver, just over to you quickly.
I think if the pressure of the public is high enough, every politician would change any law in favor of the public, not in favor of the bondholder. Because we've seen it in Greece, we've seen it in Italy. The retail client or the public is always first for politicians. So that's the risk on every investment we make, because a law is changed very fast in favor of the public.
So as an investor, when you look at a covered bond, taking that into consideration, what is it you're thinking about in terms of the likelihood of risk of that happening when you look at the various regimes and the likelihood of change? I mean, the Fahrenbrief market has been around for hundreds of years. That presumably counts for something. What is it? How do you assess the risk of the covered bond, of a change in the law and
First, we look at the covered bond law at first, and it's the main investment decision. First, the covered bond law and the issuer. How reliable is the issuer? The political risk you cannot measure in the investment decision, in my opinion. And therefore, there are two big things: covered bond law and the issuer.
I think the antidote to political risk will always be transparency. I mean, the best antidote, obviously, like you said, you can't really, if we're talking true uncertainty, obviously you can't model that anyway, but if the market is transparent, if you have good data on people's ability to pay, on good income databases, and obviously good cadasters, good property registers, and good valuation models, that would be at least some protection against the political risk. I think actually it would be interesting to hear from the other investor also how do you mitigate what you perceive to be the biggest risk factors?
Diversification.
I'm sorry?
Diversification.
Exactly.
We're already at the end of our panel session. It seems like we could have gone on for quite a lot longer, but anyway, we've come to an end. So before we actually formally finish, I just wanted to ask if there anybody who's got any questions for anything that we've discussed today on the panel, please put your hand up. So no questions, so that brings this panel to an end. Thank you very much.
Thank you.
Thank you.
Thank you.